So we were still handling part A, and we had done some computations. We had done some computations up to working number 6. So after working number 6, what you're supposed to do is to prepare your computation, your template. After direct costs, you will have the contribution. Basing on what we did, you will have the fixed costs, because we had the working for fixed costs. Then after that, you will have the taxable cash flows. Then after that, after taxable cash flows, you tax your cash flows at 30%. You tax your cash flows at 30%, then you will get the after tax cash flows. You will have the after tax cash flows. After that, you look at your initial outlay, because we did that. After initial outlay, you have things related to the scrap proceeds, and put the word net scrap proceeds, or you just capture scrap proceeds. Okay, then from there you have your tax relief. Then after that, you have your what? Working capital. All these ones we have them. Okay, then from there, you'll have the net cash flows. You'll have the net cash flows. After net cash flows, you are going to discount factor. We had computed the discount factor as 20%. Our cost of equity, which is ungeared, we computed this. So you discount your cash flows, then you get the PVs by getting net cash flows times discount. Then you'll be in a position to get base case NPV. Okay, so I believe this one you can't fail, because we have everything. So you will have year 0, you have year 0, here you have year 0, year 1, year 2, year 3, year 4, and year 5. Plus, do we have year 6? Yes, because of our tax related part. Okay, so this is what you will have. You just press your figures. If it's revenue, you put your figures. Okay, I don't want to do that. Just I wanted to show you the format. So the base case NPV, you add all the PVs from year 0 to year 6. From year 0 to year 6. You will have this one as negative 12,360. Then here, after putting everything here, you will have this. Then here you will have 2,510. Then here you have 2,278. Then here you have 1,606. Then here you have 5,302. Then finally you have negative 612. That is after pressing your figures, all of them, and you get your PVs. Okay, get your PVs. Of course, as you get these PVs, you're getting the net cash flows times the discount factor. Okay, how do you get net cash flows? Some of you, when you're not practicing, you may wonder. As you get your net cash flows, you get the after tax cash flow, then add all these things. Initial outlay as a negative in year 1, working capital working capital, you have the working capital from your computation. Those who follow, these are your working capital. Year one, year zero, you put this. Year one, you put this. But remember, I told you these ones are negative. These ones are negative. So as you put them as negative. Then in year five, you put this one as a positive because you are recouping. Okay, that is where people make mistake. Then also under working tax relief, also students make mistake. When you're putting tax relief, you put them as inflows because this is inflow. This is a tax credit. So it's an inflow. You put it as a positive. You don't subtract. Okay? That's where students make a mistake. All right. So once you have your total, you will simply add. You simply add all these values from 0 to yes, from 0 to year 6. You add and get your base case NPV. And this is base case NPV. Once you have your base case NPV, then you proceed because the question is, if at all we are looking for IRR or NPV, we'll stop here. But we are using APV. And because you're using APV, you need to proceed and now look at the financing part. Look at the financing effect. The financing effect. Because as you get your base case, rather as you get your APV, you need to look at the financing effect. Now, how is the proposed investment going to be financed? It's the question you need to ask yourself. How is the proposed investment going to be financed? Okay. And when you look at the question, in our case study, they told us that the proposed diversification, debt and equity, very, very, very key. You are going to finance the proposed diversification by both debt and equity in DHL's existing capital structure proportions. Remember, we saw the existing capital structure proportions. We saw them somewhere. Somewhere we had those proportions. These were the proportions 35 and 65. DHL has equity beta and the existing capital structure, which comprises of debt and equity in proportions of 35% and 65%. So the proposed diversification is going to be financed with also that kind of proportion. Okay, so once you see that, it means that here you have the existing proportions. The equity is what? The equity is what? 65%. Then the debt will be 35% as we finance the proposed investment. But when you look at what the examiner has told us here, he is saying that the debt finance will be sourced from TBL. Okay, the debt finance will be sourced from TBL and UDB, Uganda Development Bank. So you have two sources. TBL is willing to offer finance amounting to shillings 1,700 million. Okay, that is TBL. TBL is willing to offer finance amounting to shillings 1,700 million at annual interest rate of 20% for a period of 4 years and associated issue costs of 5%. So that is from what? TBL. Then the balance of debt equity will be financed by a 5 years subsidized term loan from UDB at an annual interest rate of 8%. All interest costs are payable at the end of each year. Principal is payable at the end of the loan term, and the debt finance is assumed to be risk-free. All these ones matter. The equity finance will be raised through a rights issue of 2 shares for every 3 held as at the date of issue, with associated 5% issue costs, which are tax allowable. The risk-free rate, okay. So it means that here you need to really know that the reason why examiner is giving you all this information because you're using APV. Now, as we proceed, first of all, how much do you want to invest? What is the cost of financing? How much will you spend on this proposed investment? We saw that the amount, the proposed amount. What was our initial outlay? What was our initial outlay? Was it 9,500? 9,500. That was that's all the money we need. 9,500 million. But out of 9,500 million, 65% will be equity. 65% will be equity. So equity is how much? Then 35% will be debt. So first tell me here, it's how much? The equity we need how much? Equity we need this, then debt we need the 35% times 9,500. So that's what we need. That's what we will use as we do these computations. All right, so once you have this, out of this money, debt, out of this money, this is the total debt. Out of this money, you will receive some money from TBL. The debt finance from the debt finance from TBL will be how much? They told us that it is shillings 1,700 million. Okay, that will be the debt finance from TBL. Then the debt finance from the Uganda Development Bank will be the balance. What is the balance? You get 325 million minus 1,700 million. Here you get how much? Here you get how much? The balance?
Get 1,625.
So that's what I have. So now I can now start handling what will be the financing side effect from these two. So I can start with the DTB, the TBL, and the TBL. As you deal with these things.
Excuse me. Excuse me,
Yes,
Abe.
please. Yes, please.
What do you consider to say, let me handle this debt from this bank or from this client?
Okay, in the question they gave us, you follow the question, because here you see, they told us that the debt finance here, they told us that the debt finance, this one, will be sourced from, you have this bank, and also what? And also DTB. So examiner will tell you. But they are telling us that the TBL is willing to offer how much? This one. So that's what you that's what you will get from TBL. TBL. Someone who asked, are we together?
Yes.
Then there is where they told us that while the balance, you see this, while the balance of debt finance, remember you have the total debt finance. So that balance will be sourced from UDBL. So examiner will give you a hint. Sometimes you may find that you have only one source. This debt finance is from one source. But where you have two sources, of course, you separate. Is it okay?
Cool.
Someone? Oh, I didn't get your question clearly.
No, it's okay.
All right. So once you have this, then we can start. Remember, as you deal with these things related to APV, as you deal with these things related to APV, there are some that you need to recall that one, when you're handling financing effect, what you need, you as a person handling this, what you need the tax relief on the debt, on the first of all, here you have the debt that will be the one from TBL. What will you save? What will you save? Tax relief is what you save. What you save on the interest. Remember, you'll be paying interest, but on that interest you're paying, there is a tax you're saving. Then also you will have the tax relief. The tax relief on the what? On the other loan, that is from UDBL. So you need the tax relief on your debt finance. That is number one. So here we are separating because we have two sources of debt finance. Then next, what else do you need? Just master the flow. What else do you need? You will need obviously also you find that we look at the net savings. The net it could be okay. The tax relief on the issue costs. The tax relief on the issue costs. We are going to, if a question has issue costs, then you must go ahead and get the tax relief on those issue costs. Now, issue costs could be on your debt, it could be on equity, it could also be on debt. As you raise the money, there are some costs you're going to incur. That's also you need to know. Then as you get your APV, you need also the PVs of you will also have the issue costs. Here you are looking at the tax relief, but look at the costs. The costs of themselves. That is the cost of debt issue costs, and also look at the PV. Look at the PV of equity equity issue costs. You need that as well. Then another thing that you may need is on cheap loan. On cheap loan, so you will need the net, the one on cheap loan. So you will need the net savings, on cheap loan, on cheap loan. The PVs of those net savings on the cheap loan. So these are, you see, guys, these things will not change. These things will not change. And this is basically what you need. Maybe plus the best case NPV that you will have. Then you add everything. This is what you need. But of course, there are steps you follow to determine all this. It doesn't mean that every question you're going to do will involve all these things. You may find that you have only one loan, the loan from one source. You'll find that you don't have even issue costs in some questions, or you'll find that you have only one issue cost, maybe on debt. You may find that you don't have cheap loan. Okay, so if they are there, okay, you go ahead and look for that. Okay, so in this question of December 2024, we had everything. It is really a good number to practice. In this paper, this December 2024, it had everything. Okay, so we are going to look at each. How can we get now? How can we get the tax relief on this? And master the steps. We can start with now the one of TBL. So we need the tax relief. We need the tax relief on what? We need the tax relief on TBL loan. How do we get this? Pay attention. You need just the tax relief. How do you get the tax relief, guys? Remember, as you get this, you need the what? You need the PVs. You don't just need the tax relief. You need the PVs, the PV of the tax relief. But you cannot get PV when you don't have actually the relief. So how do we get the relief? Shortcut in an exam can work. First of all, for you, okay, I can first give you the wrong approach. You need the interest you pay on this loan. How much do you pay as interest on this loan? What was the tax rate? On this loan? The tax rate on this loan was what?
20%.
It was 20% here. So we get the 20%. Other people use the table. As I told you, these things, it all depends on you. Other people use the table, but you can use also this approach. 20% times the loan amount, which is what? Which is 1,700 million. And here, what you get will simply be the interest expense. The 20% times this. Here you're getting the interest, but you don't want the interest. You need the tax relief. What are you saving? So I am supposed to pay this interest, but I will claim the tax relief of what? In Uganda, the tax rate is what? 30%. 30%, that is the tax rate, times the interest expense. times the interest expense, times the interest, times the interest expense. So you get how much? So here you have the 30% times this interest expense. So that is my tax relief. That is my tax relief. On this tax relief, I want to get a PV. So I need the annuity. Now, remember, this interest is for every year. This interest is every year. This is per annum. This is per annum. Per annum. Per annum. But remember, from our question, we saw that you claim interest. First of all, this loan was for what? This loan was for how many years? This loan was for 4 years. Are you seeing that? This loan was for 4 years. This loan was for 4 years. So it means that you are paying you're gonna pay interest for 4 years. So as you look for the annuity, you are looking at more than one period. Annuity, this is where people fail now. As you look for annuity, we want to get PV. We want to discount this tax relief into present term. So as you get your annuity, remember you discount using, as you deal with APV, guys, as you deal with APV, we use the risk-free rate We discount using the risk-free rate. We don't use the interest rate. We use the risk-free rate. Use interest rate only and only if you're not given the risk-free rate in the question. As you deal with these numbers, if you're given a risk-free rate, please use risk-free rate as you discount. Okay, so as we discount, of course, we are going to discount at what? We are going to discount what was our risk-free rate. We had used that somewhere. What was our risk-free rate? It was what? What was our risk-free rate? Somewhere examiner had given it. It is 10%. It is 10%. So it is 10%. For how many years? For how many years? You're going to 4 years now. Pay attention here. Remember, you are discounting the tax relief. You are not discounting the interest expenses. You are discounting the tax relief. So what are you going to do? The tax relief, examiner told you that these taxes are claimable according to what? Are they claimable in the year you earn, or they are claimable in arrears? What did the examiner say? In which taxable profits arise, but you have negotiated with tax authorities and received approval to pay what? To pay annual corporation tax a year in what? A year in arrears. Because it's a year in arrears, it means that you need, if you're supposed to pay tax this year, that one you will pay it next year. So because here you're dealing with 4 years, rather 4 years here, we are supposed to be looking at 4 years here. You would have claimed the tax relief for 4 years, but in the first year you are not going to claim it. Why? That one of year 1 will be claimed in year 2. So you start from year 2. So it will be years from year 2 to what? If you are stopping at year 4, it means that you will add another what? Another year. I don't know whether you're getting what I'm trying to mean here. Because here we are paying tax in arrears, a year in arrears, that simply means that that one of year 1, the one we are supposed to claim in year 1, will be claimed in year 2. So we start from year 2, and that one of year 4 will be claimed in year 5. So that's why I'm stopping on year 5. So how do you get annuity? How do you get annuity of this from year 2 to year 5? Now, from practice, you will master from practice. Now, for me, if I'm doing this, I don't need to do like this. When you just I indicated this to explain, but as you do, for you just simply first put annuity for 4 years. Then you also put the discount factor at 10%, at 10% for year 1. I know at this point you can see as if it looks to be confusing, but I am going to explain this. So go to your table, look for annuity factor of year, annuity factor, the last table, because here you're looking at more than 1 year annuity, you're looking at more than 1 period. 4 years. So that is more than 1 period. So you use the last table. Where you have annuity, this one. So we are standing here. Year 4 is here. So you get you write this figure. You write this figure, that is 3 what? That is 3.170. Then what is that one of year 1? Now, year 1, you're looking at only 1 year. You are looking at only 1 year of year 1. So you are not using this one annuity. But most times they are the same. Most times if you're looking at year 1, they are the same. Even if you use this one, they are the same, year 1 here. This is 0.90 what? Was it 0.9 is 0.9 what? 9? Like this?
9.
Okay. Okay. So finally, when you're getting the PV, the PV of tax relief on your TBL loan, will be equal to simply multiply. Get this times this, simply multiply times this, and get the answer. That is the shortcut you can.
Which of these two do we use to multiply in the interest expense?
We use all. Simply get this figure times this times this. That's why I said this is the shortcut, because here you will be simply multiplying. Here you will be just multiplying. There is another approach of first. Now, just that I don't normally, when I give a lot of methods, you can be confused. But go with the one that is easy. You see here we are looking at year 2 to year what? To year 5. So one student can first get what? Can first get that one of years, a year annuity of at 10% for what? For 5 years. Now, when you use 5 years, you will subtract. You remove that discount factor at 10% of year 1. You subtract. When you use 5, you subtract that one of year 1, which is not good. Like someone who have used this, you simply multiply and get the answer. But when you use this, it means that you will use the one of year 5 Here you go back at your table and use that one of year 5. Year 5. Instead of year 4, you use year 5. 9 is 3.9, 3.791. Then you remove this one. You remove this one. Here you will be subtracting. So it means that for you, as you get, you see how it will confuse you. As you get the final answer, it's better you get this minus this, then the answer you get multiplied by what? Multiplied by this. You all get the same answer. But me, I advise you use what? You use this approach. Someone had a question in the chat? Okay. So, just pick the method that is easy for you. But me, I would advise you go with the first approach, the one of just multiplying. Are we all good on this? Are we all good on this? We move on to the next.
Yes.
So once you get that, we can proceed and look at it. Now, because this loan had an issue cost, before I leave, I can first sort out the issue cost. I can first sort out the issue cost. Now, or you can first deal with, like the way I read my template here. You can first deal with as well this. Then you look at issue cost later. Let's first deal with the tax relief on UDBL before we look at issue costs. So the tax relief on UDB, Uganda Development Bank loan. Now, here I don't want to waste time in an exam. Like, I don't want to waste time. So what I will do immediately, I know that I will need to get the interest rate. I first get the interest expense. So what I will do is simply get the figures. What was the loan? You have the loan, but here I'm looking for the what? I'm looking for the, what was the tax interest rate on UDB? What was the interest rate? UDB interest rate, 8%. So I get 8%, that is interest rate, 8%. I multiply by the loan. What was the loan from UDB? That was 1,625 million. That now the answer I have like here is interest expense, but I don't need interest expense. I need the tax relief, so I multiply by 30% so that I can get the answer direct. Rather than first getting this, then I get this, you're wasting time. So here it's 8% times 1,625 times 30%. So that is the tax relief. Now, after knowing the tax relief, I must discount it. This loan was for how many years? This one was for how many years? It was a subsidized loan of 5 years. 5 years. Remember, if it is 5 years, remember, tax is a year in arrear. So you have to add 1 year. So it means that like here, like the way I had stated this one, it means that here you will start claiming from in year, this one you will start from year 2 to what? To year, the one of year 5. Since it is a loan of 5 years, the one of year 5, the tax relief of year 5 will be claimed in year what? In year 6. Isn't it, colleagues? So I also do the same. What is the annuity at 10%? Use the tax relief rate as you discount the tax relief rate. So it is annuity at 10% for 5 years. For 5 years. Then I multiply by annuity. No, this is just the discount factor. It's not annuity. But even if you use annuity as long as it is for 1 year, it's also not wrong. This is the discount factor at 10%, but for year one. Of year one. Already this one I have. What is this one? Of year 5, we had seen it somewhere. I think it was this one from the question. We had from the table. I hope you
Yeah,
know
it
now
is
how we
3.7.
from the table. So when you multiply, what do you get? Get this times this times this. So that's what I get. That's what I get. This will be my PV. This will be my PV of tax relief on UDB loan. I'm done. You see, is it hard? So just here, what you need to pay, what you need to know is, when am I going to claim my tax? Is it in arrears, or it's in a year? It's in a year when I make my profits. If it is in the year you are making profits, then you don't need to look at this thing. You don't need to look at this thing of adding another 1 year. No. You simply rely on only this. You simply rely on only this one, the first one. If you realize that the taxes are paid in a year you make profits, then you don't need to add this one. You simply stop here. You simply stop here. Okay. Now we are done with. Remember, as we do this APV, things will not change. It's like I'm doing it for the last time. Because the moment you master this, other things will be simple. You can even manage to do others. As I said, this was a good number. This is a good number to practice because it has everything. As you determine APV, it has everything. So once you are done with the tax relief on your loans, you can look at now issue costs. You can now look at issue costs. And what are they telling us for issue costs? For issue costs, they told us that this loan is associated with issue costs of 5%. Now, guys, issue cost, like as you get loan, there are other costs you may incur. As you process your loan, there are other costs you may incur. Secure that loan. Those are issue costs we are talking about. Those are issue costs we are talking about. Now, this is issue cost. First of all, as you determine issue cost, as you determine the present value of issue cost, the best way you can get this is to gross up. Here I think students will tend to fail just because we forget. So issue cost on what? What was the other one? It was what? Issue cost on TBL loan will be equal to, now I am giving you shortcut. Gross up first. How do you gross up? TBL loan was how much? It was 1,700 million. I gross up. How do you gross up? You get this figure, you divide by, you get that figure, then you divide by, if issue cost was 5%, this was 5%, this was 5%. This was, so I reduce the percentage by 90, by 5. So I will be left with 95. So I divide by 95, which is 0.95. Like I'm trying to, I don't want to give to go into much details, but here I'm just giving you the shortcut you can use. So once you get this is disturbing me. Let me just say, you simply get this one, then divide by 0.95. I know the 95. If each cost is 10%, then you divide by the remaining balance, which is 90%. If each cost is 15, you get your own divided by 0.85, that is 85%. You doing that, you're grossing up. Then the answer you get, this one, what you get, simply multiply by the percentage, the each cost percentage, which is now here 5%. And you will get the issue cost direct here. If you want the wrong process, guys, the gross up, the gross amount is simply the net amount plus what? Plus issue cost. That is how you get the gross amount. When I say gross up, some of you may not be understanding. Here we need the gross amount. So how do you get the gross amount? You don't have, it's Y. So since you don't have, it's Y is equal to net amount, that is the loan you received. That is 1,700 million. That's what you received. Then plus issue cost, it is 5% of growth. 5% times growth you don't have. So it is 5% Y, which is 0.05 Y. This is wrong process. So you need Y. It will be Y minus 0.05 Y, which will be equal to 1,700 million. So you will be left with what? 0.995 Y, which is equal to 1,700 million. So your Y, the growth amount will be 1,700 divided by what? 0.95. That's why here we are just using the shortcut. You don't need this. This is for level 1. Like, at this point, I think we should be knowing that if we are grossing up, just like the way we do VAT, as you get the VAT inclusive and exclusive. Okay, so I believe you know now where we are getting this. It's not like we cram work or what, but it is from this one, from this approach. So what will be your issue cost? This will be 1,700 times, okay, divided by 0.95 times 5%. That's what you have on your calculator? I want to be sure. That that's what you have.
That's what I have.
Once you get the issue cost, get the tax relief. Get the tax relief on issue cost. Tax relief on issue cost, which will be 30% times the 89. 30% times, remember, this is what we are following, tax relief on issue cost. So you have the issue cost, get the tax relief on issue cost. This 89 times 30%. Once you have the tax relief on issue cost, you discount it. I repeat, guys, as you discount, if you realize that it is a tax in area, it means that you have to claim the tax relief. The first tax relief will not be in year 1. It will not be in year 0. The first tax relief will be in year 2. That is the time that is the first year you're going to claim the tax relief. That is the first year you're going to claim the tax relief. So here, as you discount, you just simply discount factor. And the tax relief, the issue cost is not annuity. It is not for more than one period. No. As I said, you're getting this issue cost once and for all. So as you discount, using a single period. So discount factor at 10%. Still you use 10% risk-free rate of year 2. Let me hope now you know the reason why I'm using year 2 here. Because that will be the first year for you to claim the tax relief. So as you deal with this cost, always simply ask yourself now, if it is in arrears, then what will be my first year to claim the what? The tax relief. That will be, the one of year 2 will be claimed in year, the one of, I am supposed to claim in year 1, but because it is in area, I have to claim it in year 2. So what is that one of year 2? Someone tell me. We go back to our table since you're quiet. The first table, because you're looking at only 1 year. This is year 2. So I need this one. I need this one. 0.826. 0.826. And you get the PV. The PV of tax relief on issue cost. You multiply. Is that hard, guys? Is that hard?
Pardon for me, the reason is why we don't use annuity here under the issue costs.
It's a one-off transaction. It's not that every year you are paying what? You're paying issue cost. It's not like here. Remember, as we are determining tax relief on this tax relief here, this is tax relief on interest expenses. These interest expenses are per annum. You get
Okay.
per year. So you're looking at more than 1 year. But this issue cost is actual. In actual sense, issue cost should be discounted using year 0. In actual sense, issue cost should be, because it is as at that date, currently, it should be discounted using year 0. But the moment you realize that you are dealing with a scenario, a question where tax relief are claimed in area, then you consider the period, the first period you're going to claim the what? You're going to claim the taxes. So issue cost, you don't use annuity reason being you are using, it's a single period, it's a one-off transaction. It is not happening more than one period. It is happening only once. Okay? Let me hope I have answered your question.
Yeah,
So
got
that is my, I can round off, but be consistent. If you have been rounding off a whole number, keep rounding off a whole number. If you have been rounding off to 1 decimal point, keep rounding off to 1 decimal point on your final answer. So that is my tax relief on issue costs. Any question? Okay. Do we have any other issue cost? Do we have any other issue cost? Do we have any other issue cost, guys? As I said, this number can be asked on in section B. They can ask this in section B, just as APV, as I'm going to refer you to some other past paper questions. We have issue costs. We have issue cost on equity finance. So we can as well get that one. Issue cost on equity finance. So as you raise your shares, as you raise your share capital, in the process of raising your share capital, you may incur some costs. So those are issue costs. So we first, as I said, you first gross up. What was your equity? What was your equity? It was 66175. Then you divide by what is the issue cost percentage? If it is 5%, so I divide by 0.95. By doing this, I'm simply grossing up. If the percentage was, let's say, 8%, then I divide by what? 100 minus 8%, you'll be left with what? 92, eh? So you divide by 0.92 if it is 8%. So times the issue cost, which is 5%. What do you get? This is 6175 divided by... That's what you have? So once I have this, I can go ahead and get the tax relief. The tax relief on issue cost. Oh, like here, when if you know this, you simply get tax relief on issue cost. Gross up immediately multiplied by 30%. So it will be here, the 30% times 325. The tax relief. So once you get this, you discount. You discount this discount factor at discount factor at what? Discount
10%.
factor at 10% of year what?
Yeah,
Still
two.
is year two. Year two. Here it is still year two because, as I said, the issue cost. Just look at the first period you're going to claim the tax relief. That is year two. You will start claiming the tax relief in year two. So it is still like this. Okay. So you get PV of tax relief on issue cost. Issue cost on what? On equity finance. You multiply this times this. So if you round off to a whole number, you have like that. And you're done, guys. This is what? You're done with issue cost. You're done with issue cost. What else? Do you have cheap loan? If you have cheap loan, look at cheap loan. Cheap loan is like the subsidized loan. Huh? Subsidized loan. The cheap loan. Because just master that as you deal with the APV. These are the things you need. These are the things that you need. Okay? Okay. So I need the net saving on cheap loan. Net. Some people first look at the saving, then the what? The taxes. But here you need just the net saving. Now, when you're looking at cheap loan, guys, first get the net interest saving. Can you hear me?
Yes.
Now, how do you know that actually you have a cheap loan? How do you know actually that you have a cheap loan? You see here, when you look at what we have, they told us that this balance will be financed by 5 years subsidized term loan. Subsidized term loan from UDB at an annual interest rate of 8. Remember, you are getting loan. You are getting loan at what? You are getting loan at 20%. But because there is another source, and another source is giving you a loan at what? At 8%. It means that indirectly you are saving. Indirectly you are saving what percentage? What percentage are you saving on that cheap loan? 20% minus what? Minus 8%. So you are saving what? 12%. So this is 12% times what? Times what? That is the key question you need to ask yourself. Times the debt finance. Times the debt finance. The debt finance was 1,625 million. But because I am looking at net means that I want a figure without issues of now going back at tax relief. I simply need the net. So I multiply by 70%. You guys, some of you want the hard drive. If you want the hard drive, first get the savings. The savings, after getting the savings on the cheap loan, you raise what? You raise the tax, the tax expenses. You raise the tax expenses. The answer you get will be the net saving. So here you get it will be 12% times 1,625 million. You first do that. You first deal with that. Then here tax expenses, you get 30% times expenses 195. Then if you need this. Okay, that is net saving, but I can get this direct. So here it's 12%, 20% minus what? 8%. Then times the 1625 times 70%. So you get all of you get the same. Is it the same? All of you get the same. This approach, this one, is going to work when you are claiming the taxes in the year you make profits. This approach works. This approach works. Here you go ahead and discount, you get your annuity. If it was like for 5 years, you multiply for 5 years. Multiply for 5 years, the annuity of 5 years. We had that annuity of 5 years here. So you get the net. That is only if you're dealing with a question, you apply this. You apply this if you're dealing with a question where tax is claimable in the year profits are made. But now, this question is not like that. We are claiming tax in arrears. So what does that one mean? What does that one mean? What I will do, I can first get my interest saved. I first get my interest saved, and the interest saved is what? The other 20% minus 8%, then times
the amount.
Times the amount. The amount, of course, the amount is where you go to the cheap loan. What is the debt finance? Where you go to the cheaper loan. This one. Yes, where you had the cheaper loan. Yeah? So it is 1625. Okay. So there you will get the interest saved. Here you get this. Now, after getting this, I first deal with this thing alone. Then remember, this is per annum. This is per annum. I am saving this every year. So I can first get the annuity, the present annuity factor. The present annuity factor. That is for how many years? For that cheaper one was for 5 years. For 5 years at 10%. That annuity factor is what? This is from year 1, because here you are not looking at tax. First, leave out the tax component. So it means that here you're saving interest from year 1 to year 5. So the discount is 3.791. So you multiply, you get this times this. Okay, you first deal with this. So this will be the PV on interest saved. After getting this, now look at the issue of the tax relief frost. The tax relief lost. Remember, in the process of saving interest, you are losing out the what? You are losing out on the relief, on the tax relief. In the process of saving, yes, you're saving interest, but you are also losing out what? You are also losing out the tax relief. So what is that tax relief you're losing? Of course, the tax relief you're losing is the 30%. 30% of the interest saved. That is 195. So this is 30% times 195. That is the tax relief lost. Then what is the PV? Now when it comes to tax relief lost, you need to pay attention here as well. Of course, the tax relief lost, it will be the annuity for 5 years. First of all, for 5 years at 10%. You first deal with that. Then also, because this one, we are claiming tax relief in arrears. We are claiming tax in arrears. You also have to bring the one of year 2, rather of year 1 will start from year 2. Then that one of year 5 will be claimed in year 6. So that's why I have to bring in the other component of discount factor of year 1 at what? At 10%. And this was what we were doing these things at start. So here you multiply. You simply get this times this times this. So that's what I have. So finally, once you have that, you can get the net interest saved. The PV of net interest saved on a cheap loan, which will be 739 minus 202. The total interest saved, the PV of the total interest saved minus the PV of the tax relief lost. This is something that you need to take note of, especially if you're claiming the tax in arrears. Okay. When you're dealing with tax, ask yourself, when are you claiming tax? When you're dealing with interest, of course, like here, interest is nothing like that you're going to pay interest next year. No. Okay. Okay, so finally, I think we are done, guys. We are done with everything. And once you're there, so you will see that the reason why I did this, in the guide, the examiner, the one who made the guide didn't do like this. For him or her, the one who did the marking guide, what he did, He looked at what? He looked at interest. He looked at he for him he simply looked at net interest saved. Net interest saved on cheap loan. Whereby you're getting the what? The 20% minus the 8%. Then times the other loan from UDB 1625. Okay, that is the net interest saved. Then times the 70%, just to remove the tax component. Okay, but I want to explain where I feel like it's not coordinating. After getting this, he discounted. Just pay attention on how he discounted, which I feel like looks not to be coordinating. When you are discounting, he assumed that, of course, as usual, it's if you're from year 2, so it's at 10%. For years 2 to what? To 6. That is from year 2 to year 6, because of the tax component, tax effect, and of course that one is like this. Is like getting. Is simply like getting this times what? Times this. Okay. Okay, that's what he used, like getting this times this. Okay. Now his answer was this times what? Times this times this. Which you see, they are totally different. And why? To me, I feel like there is a difference. There is a difference. Because yes, you are getting the net saving, the net interest saving on cheap loan. But you are looking at the total saving, the total interest saved, the total interest saved. Yet for total interest saved, it's from year 1 to year 5. If you discount, you cannot bring things of year 2 to year 6 as you discount, because that one is you're paying interest in that very year. It's not that you're paying interest in arrears. No, it's only the tax that you're claiming in what? In arrears. This is PV on total interest on interest saved. Then this is PV on tax relief first. Just what is left is to put these things. You put everything here. Put everything here. Issue costs, you put them as negative because these are costs. You put them as negative. Then others, tax relief, these ones are credits. The net saving on cheap loan is also a credit. So all other things are positives. Best case NPV, if you had a positive, you put it as a positive. And sum up. What you get will be your APV. You just place your figures here. Because we have everything now. We have everything. Any other question? Any other question? We are done with APV. Please practice. Just you see, I didn't rush. I wanted you master because it can be part of your question. It can be part of your question B. Past paper numbers to try. Past paper questions to try. past paper questions to try. I am going to send them in the group. Let's stop here. We meet next time. Have a good night.
Thank you. Good night.